Hi everyone, welcome back. If you are new here, this channel is all about understanding money and the US stock market in a very simple language. In the last video, we talked about what does the US stock market actually is. Today we are going to answer a very common beginner question. How do people actually make money in the US stock market? Let's keep this super simple. First, let me say this clearly. The stock market is not a get rich quick system. It's a long-term wealth building tool. Now, there are three main ways people make money in the stock market. The first way is price growth. This is the most common one. Let's say you buy one share of a company for $100. If that company does well, more people want to buy it because of demand. The stock price goes up after some time. That same stock might be worth $150. You buy it at 100. You sell it at 150. That $50 difference is your profit. That's called capital gain. Very simple. But remember, price don't go up every day. Sometimes they go down. That's normal. The stock market moves up and down in the short term. But historically, it grows over the long term. The second way people make money is through dividends. Some companies share part of their profit with shareholders. That money is called a dividend. For example, if you own share of a dividend paying company, you might receive cash every 3 months. You don't need to sell the stock to get this money. You just hold it and the company pays you. Many Americans use dividend stocks for passive income, especially for retirement. The third way people grow money is by reinvesting. This part is very powerful. When you earn a dividend or profits, instead of spending that money, you use it to buy more stocks. Over time, this creates a compounding effect. Your money starts making money, and then that money makes even more money. This is how long-term investors build real wealth. Now let's talk about something very important. Time in the stock market, time is more important than timing. Many beginners try to guess when the market will go up or down. Even professionals get this wrong. Successful investors focus on staying invested for many years, not on daily price movement. That's why many Americans invest monthly, no matter what the market is doing. This strategy is called dollar cost averaging. You invest a fixed amount regularly. Sometimes you buy at high price, sometimes at low prices. Over time it balances out. Now a quick warning. The stock market always has risk. Price can fall. You can lose money in the short term. That's why you should never invest money that you need for rent, food or emergencies. Stock market money should be long term money. In the next video, we talk about the difference between stocks, ETFs and index fund and which one is for beginners in the US. If you are finding this helpful, hit the like button so YouTube show this to more people. Subscribe if you want to understand money the simple way. Thanks for watching and I will see you in the next video.